In this learning, we are continuing with our equity valuation and firm valuation. But in this, we are using free cash flow approach and we will be discounting the free cash flow to the firm to calculate the firm value. So let us start with an example. But maybe before example, let us understand the concept and formula. So the concept here is that we are doing free cash flow valuation and we are using cash flow valuation model. So we will do what? We will find the present value of all the free cash flows or expected cash flows, and we will discount these cash flows at weighted average cost of capital. So when we are having free cash flow to the firm number available, so this is discounted at weighted average cost of capital. And when we have free cash flow to equity number available, then we will be discounting it at required return on equity. So first we will start with this part. We will have free cash flow to firm number, and then we will be discounting it at weighted average cost of capital. Let us go into a scenario, and in this scenario we will be using this formula, right? So we will be finding the firm value at 0.0, and for this we will be discounting the cash flow. So cash flow to firm will be discounted for 1 year, right, at weighted average cost of capital, and free cash flow to the firm for second year will be discounted for 2 years, and so on. We do it up to infinite number of cash flows that are available to us. So interestingly, this equation or this formula goes up to infinity. However, we do the calculation and we do the summation of present value of free cash flow to firm only when free cash flows are constant forever. When this condition is met, or when free cash flow grows, but it grows at a constant rate forever. And third is free cash flows eventually grow at a constant rate. But in this learning, we are not talking of any growth rates. So in this learning, we are assuming that there is no growth rate, and we are just calculating, or we are just discounting the free cash flow to the firm, which are perpetual cash flows with no growth rate. So in this learning, we are doing this thing. And actually, let us learn this through a scenario. Suppose there is a company, ABC Hypo. So this company has raised some debt and has collected some money through equity as well. So this total money is something that has given it some assets. And with these assets, this company has started some business, maybe let us call equipment leasing business. And this firm is now having some cash flows. So first year, this has a cash flow of 400,000, and this is a constant cash flow for 4 years. So this project is giving constant cash flows for 4 years, and for each year this is 400,000. And assuming that weighted average cost of capital is 12%, let us find the value of a firm in this case. So we will be using the same formula. So free cash flow to the firm for first year will be discounted for 1 year, and so on. So we have fitted all the numbers in the formula, and we will do the discounting here. So let us use our BA2 plus calculator to do the discounting. So let us use cash flow function here. We click on CF, cash flow function, and then we click on second and then clear work. So this way anything in the cash flow function memory of the calculator is cleared out. Second quit, come out of it. Now we have 400,000, which is constant cash flow for each year starting with year 1. So actually I can store it in first memory slot. Then let us go back to cash flow function, and it is asking for CF0, right? So this is 0. click enter, go down. So first cash flow, recall 1, enter, go down, frequency is 1, go down. Second cash flow, recall 1, enter, go down, go down. Third cash flow, recall 1, enter, go down, go down. Fourth cash flow, recall 1, enter, go down. And definitely now we have to calculate NPV. So when I hit NPV, it is asking for I. I is nothing else but weighted average cost of capital, which is 12%, and then enter, and then go down NPV. NPV it is asking for. Actually NPV is something that we are trying to calculate. So let us hit the compute button, and the NPV is 1,214,939.739. So we got this number for the firm value today. Now actually we could have done this with the TVM row as well. Let us try doing that. Clear screen, second clear TVM, 400,000 is payment, 4 is N, 12 is IY, compute present value. This number is also 1,214,939. So we get this value of firm today either using cash flow function or using TVM row, but here we had taken couple of assumptions, remember, and the major assumption is that this 400,000 is cash flow to the firm and it is a constant number, so there is no growth happening here. So we are assuming that there was no growth expectation in cash flow. Then we can use simply the discounting of cash flows to calculate the firm value.